Alright, hello everyone. Let me go over some questions in chapter 14. Alright, first question. A firm can increase, decrease, or more information is required is return on equity by using more debt in the capital structure. Now, if you look at the relationship between ROE and let me use a pen here. Okay. If you look at the relationship between ROE and ROA and the interest rate, here is okay. If the return on assets is more than the interest rate, so what it means is this one will become positive. Alright, so the more debt the company is using, okay, the more debt the company is using, the ROE, okay, will be higher. Okay, it makes sense because if the company has more return than the interest rate, okay, the rate of return on assets of the company is higher than the interest rate. Obviously, it would make more sense if the company borrows more debt. Okay, so the higher debt the company has, the more return on equity. However, if return on assets is smaller than interest, okay, meaning ROA minus interest is negative. So if the company is using more debt, okay, the ROE actually will be smaller. Okay, so over here we don't really know that by using more debt ROE will be higher or lower, because it also depends on the relationship between ROA and the interest rate. Okay, so obviously over here more information is required in order to answer the question. Now number 2. Alright, so if the question is asking you what is the profit margin. Okay, margin basically, alright, margin is equal to EBIT, alright, over sale. Okay, and you can break it down as the following: EBIT, okay, over total assets times total assets over sale. Okay, it's the same thing. And EBIT over assets, you know that it is ROA. Okay, and assets over sale, you know that it is 1 over assets turnover ratio. Okay, 1 over total assets turnover. Alright, so you can see easily that the profit margin, this is the gross profit margin, would be equal to ROA, which is 16%, alright, over turnover ratio, which is 2, and equal to 8%. Okay, number 3. What is a company debt to equity if assets to equity is 2? You know that assets to equity is assets is debt and equity, okay, over equity. So it is equal to 1 plus debt equity ratio. So the leverage ratio, which is assets over equity, is equal to 1 plus debt and equity. And you know that this is 2 and this is 1. So the debt equity ratio has to be equal to 1. Alright. Number 4. Alright, number 4. This company has an ROA of 11.9. Debt equity is 2/3. Tax rate 30%. Interest rate on debt is 12%. How much is ROA? Okay. So this is a relationship between ROE and ROA. So you put in the formula, ROE is 11.9, the tax rate is 30%, and you solve for ROA. Okay, solve the equation, you will get ROA equal to 15%. Alright, very simply apply the formula, you should be able to get the answer. Number 5, the assets turnover of the company. Alright, assets turnover basically equal to assets, equal to sale over total assets, that is assets turnover. It tells you how efficient a company is using assets to make sale. So the assets turnover can be improved by investing more efficiently, efficiently with the assets. Okay, if the company is using assets more efficient, the assets turnover will definitely be higher. Number 6, what is the most correct relationship between the company's ROA and ROE and ROA when the company does not borrow any debt? So the formula is right here. If there's no debt, this would be equal to 0. So 0 times any number would be equal to 0. So this would be equal to 0. So as a result, you will have ROE equal to 1 minus tax times ROA. And you know that tax is positive and smaller than 1. So 1 minus tax is always smaller than 1. Okay. So any number times a number smaller than 1 will be smaller than that number. So ROA times a number smaller than 1, and that would mean that ROE is smaller than ROA. Okay. Number 7, capital structure, but can be determined by obviously balance sheet. Okay, how much debt and how much equity. Which one of the following is not considered an asset? Obviously, it is accrued taxes. It is liability. It is current liabilities. Okay, now over here, number 9, you are given ROE, which is equal to net income, alright, divided by equity. Okay, net income divided by equity, and this is equal to 20%. Right, market to book, basically it is equal to market value of equity. It is a price, okay, per share. The price divided by equity, book value of equity, okay, equity per share, alright, and this is equal to 2.38. So using the DuPont, you have the following. Okay, the PE ratio equal to price per share over earning per share. Okay, so the price per share over earning per share. So you can break it down into price over equity per share, okay, or price over equity, okay, per share times equity per share, okay, times equity per share. This is equity per share because earning per price over earning. And I'm sorry, this is not equity, this is earning per share. Alright, let me start again. Alright, you have so the price earning, okay, price PE is equal to price over earning per share, okay, and then you can use the following. You give a price over equity per share, okay, times equity per share over earning per share. Okay, now price over equity per share, which is basically market to book. Okay, price per share over equity per share, which is market to book, equal 2.38. Equity per share over earning per share, which is basically 1 over ROE, okay, because this is total net income divided by total equity. So if you divide by number of shares, you will get earning per share over equity per share. So this ratio basically it is 1 over ROE. Okay, so you equal to 2.38 times 1 over 0.2, and it is equal to 11.9. Okay, so the price earning ratio is equal to 11.9. Number 11 to number 14. Okay, now current ratio. Alright, asking you to calculate current ratio. How do you get current ratio? Current ratio is equal to current assets over current liability. How much is the current assets? it is equal in 2005, so it is equal to basically 1,150,000 over current liability, which is right here, 800,000, and equal to 144. All right, and firm leverage ratio. Okay, leverage ratio is equal to basically the assets over equity. Okay, assets over equity. So how much assets over here? Assets is the total assets of the company is 25. Okay, total assets of the company is 25. See that total assets now the question is asking in the year 2004. Okay, the year 2004 total assets is 2,500,000, and the equity in 2004 is what is common stock, which is 200,000, plus retained earnings, which is 600,000. All right, so you have it is equal to 2.5 million divided by 200 plus 600. Okay, and equal to 313. The fixed assets turnover. Okay, okay, the fixed assets turnover is basically equal to sale divided by average fixed assets. Okay, whenever you calculate a ratio that that requires the information from both income statement, for example sale, and the balance sheet, for example fixed assets, the item in the balance sheet has to be average. Okay, so the sale in the year 2005 is equal to 5 million. Okay, in the year 2005 is equal to $5 million. Average fixed assets, which is the beginning of fixed assets plus ending of fixed assets. Okay, beginning of fixed assets is 1,550,000. No, this ending. Beginning is 1,400,000. Ending is 1,550,000. Okay, so you get the average of the two. 5 million over the average equal to 339. Very similar. The assets turnover is equal to sale divided by average. Okay, average total assets. Alright, so in 2005 sale is 5 million. Average total assets is 2.5 million plus 2.7 million over 2, and you get the total assets turnover is 192. Okay, now calculate the change in the cash flow. So you start with net income 970. The taxes payable decreased by 120. When the taxes payable decreased by 120, it means that the company is using cash to pay off taxes. Alright, so that would lower the cash by 120, and you have to add back depreciation 85 because you subtracted depreciation before in the income statement. Fixed assets are sold for 90. Alright, so you get $90 in fixed assets. Inventory declined by 65, so you are able to sell more in inventories by 65. Okay, so the total would be 1090 increase in the cash flows. Okay, now yesterday this company buy raw materials on credit. If the current ratio was 2 before, what effect did this transaction have on the current ratio? Alright, so if the current ratio basically equal to current assets over current liability, so this is equal to 2. Alright, before the transaction. So say for example current assets was 4, current liability was 2. Alright, now if the company purchase raw materials on credit, so what it means is after the transaction, the current ratio, for example, purchase 1. Okay, if you purchase on credit 1 million, alright, $1 million, this is 4 million, this is 2 million. Alright, so if you purchase $1 million on credit, meaning the inventory will increase by 1 million. Alright, so therefore the current assets will increase by 1. So you would have 4 plus 1. Alright, at the same time, because you buy on credit, current liability will also increase by 1 million. So the new current liability would be equal to 2 plus 1. So the new current ratio would be equal to 5 over 3, which is obviously smaller than 2. So what it means is, if the company buy raw material, if the company buy raw materials on credit, that transaction would increase both current assets and current liability by the same amount, but that amount will affect the numerator more than it does to the will affect the denominator more than it does to the numerator. So therefore, after the transaction, the current ratio would be lower. Okay, before it was 2, and now after the transaction it is 5 over 3, which is basically 1.67, smaller than 2. Okay. And number 16. Alright, an increase in account payable. Okay, if account payable is if account payable increases, okay, what it means is the company has not used cash to pay off account payable, so therefore the amount of cash would be higher. Alright, so so the increase in account payable will be added, okay, will be added to the net income when computing the cash flows. Okay, which one is the profitability ratio? Obviously return on equity. Number 18. Okay, very similar to one of the question before. What is operating profit margin? So you have EBIT. Okay, EBIT profit margin is EBIT over sale, and break it down into EBIT over assets times assets over sale, right? EBIT over assets, which basically equal to ROA, and assets over sale, basically it is 1 over turnover. Okay, so you have it is equal to 16% over turnover, which is 2, and this equal 8%. Okay. Now, using the number 19, using the DuPont system, the ROE would be equal to basically equal to tax burden. Okay, tax burden. You break it down into net income over pre-tax. Okay, times pre-tax. Okay, over EBIT times EBIT over sales times sales over assets times assets over equity. Alright, so net income over pre-tax, which is a tax burden. Alright, and you know that the tax burden is equal to net income over pre-tax, and net income basically is the pre-tax times 1 minus tax rate, okay, over pre-tax. So this ratio basically is 1 minus tax. So this is 1 minus tax. Okay, the first number is 1 minus tax. Pre-tax over EBIT, which is the interest burden. It is given as 0.7 in here, and times EBIT over sale, which is a operating profit margin 10%. Sale over assets, which is the assets turnover, which is $2 in sale per dollar of assets, times 2. Assets over equity. Assets over equity is equal 1 plus the debt equity ratio. So debt equity ratio given as 0.7 0.5, so it is 1 plus 0.5 and equal 1.5. So times 1.5, and the tax rate basically is 25%, so 1 minus 25.25. Okay, so you multiply all together, you get, this is the answer, 15.75%. Number 20, very similar to what you had before, using this formula. Okay, you know the tax rate is equal to 20%. ROA you are looking for, ROE is equal to 12%. Interest rate is 10. Debt equity is 0.4. Alright, solve the equation, you get the answer is 13.6. Number 22, the price earning ratio, PE, basically equal to price over earning per share. Okay, and ROE equal to net income over earning per share. Okay, net income over net income over equity. Okay, now so the question is asking market to book, which is the price over equity per share. Okay, so so we can break it down. Price over equity per share is equal to price over earning per share times earning per share over equity per share. So right, so market to book is basically price per share over book value of equity, which is equity per share. Okay, so you break it down into here, price over earning per share times earning per share over equity per share, and price over earning per share, which is a PE ratio, earning per share over equity, which is basically net income. Alright, and earning per share over equity per share, which is ROE right here. This is total net income. This is total equity. So the ratio would be the same as when you divide both numerator and denominator by the number of shares. So if you divide both of them by number of shares, you have earning per share over equity per share. So you have PE times ROE. PE is 20, ROE is 0.15, and this is equal to 3. Okay. Number 23. Two identical companies X and Y using different inventory valuations during a period of increasing prices. X, using a LIFO, and Y is using FIFO. Right, so if the price increasing over time, right, and so LIFO means last in first out, using the last unit. If the price okay, for X, the cost of goods sold, okay, if X is using the last unit and the price increases during the year, so cost of goods sold would be high. Okay, and Y using FIFO and the price increases, so Y using the first unit, so the cost of goods sold would be low. Okay, would be lower. And the inventory level in the balance sheet. So when X is using last in first out, they are left with the the first items. So the ending, okay, the inventory, okay, the inventory balance, because for X it is left with the first unit, and the first units are with lower price, so this would be low. And this one is using the using the first unit, so the ending inventory, okay, ending inventory would be left with the last unit, and the last unit are the one with high price, so the inventories over here would be high. Okay, so X would have obviously higher cost of goods sold and lower inventory. So higher cost of goods sold and lower inventory. All right. Number 25, okay, common size of current assets. When you calculating the common size percentage, dividing the item by the total assets. So you have current assets right now 1994.50, and the total assets is equal to total liabilities plus equity. So you have 28,505 plus 54,700. Alright, and the answer is 11.42%. Which one of the following will increase current ratio but not quick ratios? Obviously the current ratio, okay, current ratio is equal to current assets over current liability, and quick ratio is basically equal current assets minus inventory, okay, right, over current liability. So obviously, quick ratio excluding inventory. Alright, so anything related to inventory will not affect the quick ratio. So obviously D is the answer. Number 28, the current ratio, okay, currently is equal to current assets over current liability, and it is equal to 2. If the company used cash to retire note payables within 1 year, alright, for example, before the transaction, current assets was 4, current liability was 2, and this is 2, right? Now after the transaction, that the company used cash to retire note payable, so both current assets would reduce, so the current ratio, new current ratio would be equal to, so if the company use $1 cash to retire, right, to retire note payable, so the new current assets now would be 4 minus 1, and the new current liability now would be 2 minus 1, because current liability has decreased by 1. So the new ratio now is equal to 3 over 1 and equal to 3. Okay, so therefore the current ratio would increase. How does it affect the assets turnover? The assets turnover, ATO is assets turnover, equal to sales divided by assets. So obviously sale is the same, assets is lower because cash is smaller. So obviously this rate, if sale is the same, okay, this is lower, so obviously the ratio will be higher. Okay, now this is similar, you put in the formula and you should be able to calculate ROA. Number 30, basically using the DuPont system. Alright, DuPont system, ROE is equal to tax burden times interest burden times operating margin times turnover times leverage, and you have all the answers in here, and ROE is 13.5%. Alright, now you are given the income statement and the balance sheet. Calculate different ratios. Okay, inventory turnover ratio is basically equal to cost of goods sold. Okay, how much is the cost of goods sold? Inventory turnover is cost of goods sold divided by average. Okay, cost of goods sold divided by average inventory. Okay, 32, debt equity equal to debt over equity. Alright, debt equity ratio equal to debt over equity. Okay, how much is debt, how much is equity? Debt in 2009 is 3340, equity is 960. See that amount of debt is in 2009. Alright, total liability is over here 3340 and equity is 960. Number 34, calculating the 33, calculate the cash flow from operating activities. Alright, when you calculate the operating cash flows, first, operating cash flow, you start with net income. Okay, you add back depreciation and you make the adjustment. Okay, you make the adjustment on account receivable, on account payable, and inventories. Okay, make all the adjustment on account receivable, account payable, and inventories. Okay, for example, net income is 410, you add back depreciation 280. Now look at the account receivable here. Account receivable at the beginning of the year, okay, account receivable at the beginning of the year it is 480, at the end of the year it is 490. So account receivable increased by $10,000. When account receivable increased by $10,000, the company has not been able to collect cash yet, so you have to lower it. It lowers the cash. So subtract this is inventories. Alright, account receivable beginning of the year is 660. Okay, and beginning of the year 690, at the end of the year is 660. So basically account receivable, okay, account receivable decreased by $30,000. When account receivable decreased by $30,000, that would add to the cash the company has, because the company has been able to collect cash $30,000. So cash would increase by $30,000 because of decrease in account receivable. Alright, so you can see in here, change in account receivable 30,000, you add, okay, because it would increase the cash, so you add $30,000. Now look at account payable. At the beginning of the year it was 450, at the end of the year it is 340. So account payable decreased by 450,000 minus, okay, decreased by an amount 450,000 minus 340, basically equal to 110,000. Okay, so account payable decreased by 110,000. So if the company has, so if account payable decreased by 110,000, meaning the company is using cash to pay off account payable. Okay, so the amount cash would have to be lower. Right, cash would have to go down by an amount equal to 110. Okay, 110,000. So you can see that account payable decreased by 110. Okay, and look at inventories. Inventories basically at the beginning of the year it was 480, at the end of the year it was 490. So inventory increased by 10,000. When inventory increased by 10,000, the company it would lower the cash of the company. Okay, so cash would lower by 10,000. So over here, so okay, so negative 10,000. So you have all the numbers in here: 410,000 plus 280 plus 30 minus 110 minus 10, and you have $600,000. Okay. Now, what is the average collection period? Now, how do you calculate average collection period? First, you calculate account receivable turnover, which is equal to sales divided by average account receivable. Okay, it tells you how many times the company is able to turn over account receivable, and you know that sale is equal to 5,500,000 dollars. Okay, so equal to $5,500,000 divided by average account receivable, which is 660 plus 660,000 plus 690,000 over 2. Alright, account receivable at the beginning was see that account receivable at the beginning was 690 and at the end it was 660. So the average account receivable was 660 plus 690 over 2. So the answer is, it is equal to 5,500, 660 plus 690 over 2. Alright, so account turnover is equal to 8.148. Now, but how long it takes to convert account receivable into cash, which is the average collection period, and this would be equal to 365 over account receivable turnover. Okay, so this is equal to 365 over 8.148, which is equal to 4479, okay, or 4480. So this is equal to 44.80. Basically, this is how many days it takes to convert account receivable into cash. Okay. Assets turnover, this ratio equal to sale divided by total assets. Okay, average total assets. Right. Now I think this one, alright, sales basically equal to assets turnover, sale equal to 55, alright, 5,500 over average total assets, which is 4,300 plus 4010. Okay, 4,300 plus 4010 over 2, and this one is equal to 4,300 plus 410 over 2. Okay, and this is equal to 1.33. right? Interest coverage, the interest coverage is equal to basically EBIT, right, over interest. How many times the operating income can cover interest expense? EBIT is 870 over interest expense is 130, and this is 6.69. okay, operating profit margin is equal to EBIT over sales, and equal 870 over 5,500 and equal to 2.16. Return on equity, is equal to net income over average equity. Okay, net income over average equity. Net income is 410. Equity, average equity is 960 plus 810 over 2, and the answer is 0.46. Okay, so what it means is whenever you have to calculate a ratio that that needs information from both income statement and balance sheet, the items in the balance sheet have to be average. For example, return on equity, here you are using net income from income statement and equity is coming from balance sheet. You have to average equity. Alright, so you have 410 over 960 over 810 over 2, which is the average, so the answer is 0.46. Alright, so that's pretty much about it. Any question, let me know. Okay, thank you very much.